In this video, guys, let's look at a simple guide to risk-reward ratio. What does it mean? Why is it so important? Stay tuned. Hey traders, warm welcome to you. So if you're new-ish to trading and you've heard kind of risk-reward ratio, people talking about this all the time, maybe you said you've got to have a high risk-reward ratio. What does it mean? How do you calculate it? And why is it important? So this quick guide, guys, I'm going to run through a kind of example and talk a little bit about why it's so important. If you can master this aspect of your trading, everything else becomes a lot easier. Okay, so risk-reward ratio. When we're taking a trade, we really have two parameters that are quite important to us. And one is the risk we're taking on the trade. The other is the potential reward on the trade. Okay, now we're not talking about money at the moment. We're talking about the actual distance from your order entry to where your stop loss is going to be. In a stop loss order, it activates to prevent any further loss. And I say a take profit order or a limit order to exit a trade is where you're taking profit. So your potential reward and your potential risk. And what we're doing when we're structuring the trade is we're looking at those two and the ratio between the two. And ultimately what we're trying to do is risk a small amount to make a large amount. Now that's oversimplifying it, but ultimately when we can get that into that situation, it means that we don't have to be as accurate with our trades. We can get half of them wrong and have a 50% positive, profitable trade ratio. But if the risk-reward ratio is high, we're making much more when we win than when we lose, then we're going to make money over time. So that's why it's important and why we're trying to maximize it. I'm not going to talk about the technical aspects of how we do that from a strategy perspective in this video. Plenty of other videos, if you want to check them out, loads of other videos coming up if you like this kind of stuff. Okay, so let's look at it from example from a stock perspective. Now, Forex is identical, we're just changing these numbers to pips. But I think from a stock perspective, sometimes it helps visualize it a little bit easier because the money and stuff, when we talk about the money involved in it. So let's imagine now you have this chart here, you decide to go long at support, you've seen the price dip through the low and you're long at 85. So one unit, whatever that unit is, we'll look at an example in a moment, at $85. And you look at the chart and you go, you know what, I want to put my stop under that last low here. It's already dipped through, kind of a little bit of a wick, looks good to me. That's a $2 stop because the stop is 83. That low is wherever that low is, maybe that's 84. You want to go $1 below that just to give it a bit of room. So you've got to stop at 83. What does that mean? It means that if the trade, and long by the way is buying, it means that if the trade and the market goes to 83, you will cut the trade and you will take your $2 loss times the amount of shares that we're doing. We'll look at that in a moment. So your risk on this trade is $2. Now let's say you've done some technical analysis. Let's say you've decided that actually this is perfectly reasonable to expect this price to stock to potentially hit $95. So you go, right, $95 is my price target on the trade. That's where I'm going to take profits on the trade. And that reward then would be, or potential reward, is going to be $10, right? Because it's 95 minus the 85. So you've structured a trade where you're risking $2 and your reward is $10. Now, little caveat, let's just go off piste a little bit here. You can't just pick any old target. There's a kind of method that you probably should come up with. And there's guides as well, guys. I've got loads of videos on my channel. And there's other great traders out there who are kind of sharing some of their knowledge as well of how you come up with a price target. You can't just go, my price target is $1,000 without some justification. So you've got to have some structure to it. But let's assume you followed all that. Now you've got in this particular trade, if you're buying at 85, your stop loss is at 83, your take profits at 95, you're risking $2 and your reward is $10. So your risk reward ratio is 1 to 5, but many traders will say it's a 5 to 1 or a 1 to 5. It means the same thing, even though technically it is 1 to 5 because risk is 1, reward is 5. But when people say it's 5 to 1, 10 to 1, that tends to be what they mean. They say, okay, I'm risking 1 to make 10, I'm risking 1 to make 5, 1 to make 100. Now, what's a good risk reward ratio? It does depend on what you're trading. 2 to 1 should really be the minimum. If you're scalping, you might go a little bit like 1 to 1.5 because your hit rate is higher, so you can make up for that slight decrease in risk reward ratio with success rate of trades, or winning success rate. If you're swing trading, sometimes you might want to stretch it out, and there's some trades out there that are kind of 10 to 1, even 20 to 1 on some really good setups. But like I say, you've got to have that a logical price target and something that's not completely unlikely to happen. So let's look at an example. If you did 100 shares, and again, if you're trading Forex and these were, let's say, the last 2 decimal points on the pair you were trading, it would just be pips. You might say that's 20 pips and that's 100 pips, so that's 200 pips and that's 1,000 pips, and you multiply it by your lot size. But let's just keep it in the share example for now. Let's see the 100 shares. $2 risk on 100 shares is $200 risk. It's 100 times the 2. That's the risk you're taking on the deal. So if you did 100 shares of it, your risk is $200. Your price target 95 is $1,000 potential reward, because 100 shares times your 10. So your risk reward ratio now, very simply, 200 you risk in to make 1,000. And if you think about that, if you do that all the time, even if you had a 50% success rate in your trades, you would come out profitable. So that's why as traders, we focus on really trying to generate these high risk reward ratio trades wherever possible. So that's risk reward ratio, guys. If you come across something like this is how you calculate it. So if you hear about risk reward ratio and why it's so important, you can see now why we do it, why we want to have a high risk reward ratio, and what it all means. Take care in your trading. See you next one. Bye-bye.